the person who has lent out the money is at their mercy. But it's clear what the book says with respect to when we borrow, when we take debt, what we should do and how we should manage it. So thank you very much. So I'd like to start. I don't know, maybe a few people, just maybe we can get a few comments, maybe about 5 people, just to let me know what your view of debt is, what you think debt is, and what your experience has been. I don't know if we can get like maybe a few people, a few volunteers to just tell us what the experience is with debt, what they think it is, and how what the experience has been with from a business, from a personal perspective, as the case may be. Anyone? Anyone wants to share his views?
Okay, good morning, everyone.
Good morning.
Yeah, so from a personal perspective, I think that my opinion is that debt is something that should be avoided,
Right,
if possible.
right,
I think it should be a last resort, like you don't have any other choice.
right.
So I think before the issue gets to death, all
Yes.
other options should have been considered properly,
Mm,
and and then
right,
even when you're going to do, if you have to for any reason do that, then you should start with soft kind of loans, start with family, start with friends,
mm,
and all of that. And then I think interest is also very important. The
right.
duration of the loan and how
Mm,
much the interest is matters a lot.
fantastic,
So the less the better. The less
fantastic.
the better as far as interest is concerned, and the more the better as far as duration is concerned.
Right.
But then also that, we should have a high level of commitment. If you take a facility, you need to repay it, because if you don't, eventually it catches up with you. Whether
Right,
you're doing it within family or social circles, everybody
right.
gets to know that you're the type of person
Mm,
that doesn't pay back.
right,
So at some point, you're going to hit a brick wall.
right.
And even if it's
Absolutely.
for business, it's the same thing.
Mm,
There's a whole credit bureau that has all the records. I mean, you just find at a point that you are not able to borrow. And then
right.
importantly, whatever you're borrowing for, you must already know how you intend to pay it back. Where are you
Mm,
going to get the money to pay it back? Are
mm,
you putting it into business? Is it going to yield enough for you to be able to pay back within the agreed time and all of that? Thank you so much.
fantastic. Fantastic. I think you hit the nail on the head. I think you are very spot on. Even though, yes, you've highlighted all the key elements around what debt should be. Uh, One thing is clear. If you look at it in detail, and maybe we'll talk around it when we go deep, right? Personally, I kind of would tilt towards your side of the wall. But over time, I've come to see that even the richest of the rich, the large corporates, this is an area where they prefer to play. And I have tried to understand it, right? Maybe because they have the capacity to borrow, but haven't spoken to a large number of them. They will tell you that it's easier for us to raise debt than to do equity. It's cheaper, it's faster, we don't dilute our ownership. So debt for them is also a strategy. Essentially other people's money, which is what they believe is a better way to trade. But the problem is where you then don't have the capacity to repay. But I think we'll talk around. Any other person wants to share their thoughts before we move on? Okay, so maybe we'll move on. I think you can still see my slides, right? So drawing from what the from what we've already shared, right? You've mentioned something that is key, and it's a major myth that debt is something that should be avoided, and you are spot on, right? And clearly that's a myth, and and it's a major misconception that in a way sort of limit us as individuals and as businesses The reason is because we probably have within our subconscious a way that people have approached that people have already people have managed the topic or the issue of debt, and that's why in our subconscious we think that it's something that should be avoided. Whereas, if you look at, and I give an example, look at the likes of, I don't know whether he'll be a perfect example, maybe a Dangote within our climb. This is somebody that leverages debt like anything and builds wealth and continues to build wealth and he leverages debt. He's never diluting his ownership. He hardly ever goes to the stock exchange. You hardly see him raise IPOs where he's sharing ownership with anybody. You may want to call it greed, some level of greed, but it's a strategy that seems to work for him. With debt, he's able to remain in control. And one thing he has been able to do right is no matter the circumstance, he goes out of his way to ensure that he repays. And that is why he becomes very, very creditworthy. I tell you for a fact, banks would throw a party on the day that Dangote signs their offer letter for a facility to be taken from them. That's how much creditworthy he has become, and that's why it's easy for him to leverage debt, do his refinery. Now he wants to go into steel, and you'll be shocked and you'll be surprised at how banks are already throwing money on the table because he has shown capacity. So I think that misconception is something we need to deal with within our subconscious, take it out of our mind. That is something that should be avoided. Yes, it has to be properly managed. It has to be done properly. It has to be done rightly. There has to be discipline, but it's not something I think should be avoided. In fact, if you look at what the corporates do, there's something called the weighted average cost of capital. The weighted average cost of capital. So when corporate entities are looking at how much is the cost of the capital that has set up our business, what is that weighted cost? The preference, there are several theories, but the preference is for them to lean more on debt because it is considered cheaper. The cost right now in the industry, banks, so the CBN has recently said, oh, banks, commercial banks, go and raise your capital base. Give us a plan on how you want to raise additional capital because we think you need to be stronger to be able to carry the type of economy that we are seeing in the next 5 to 10 years. We want to go to a $1 trillion economy, but you don't have the capacity to finance that size of economy. So go and raise additional capital to support that. Now, Fidelity is one of the first banks that has gone to the market to say we want to do an IPO, an initial public offering, and raise capital. Now, that process in itself is very costly. It's very time consuming. The fees you pay, the legal fees, the agency fees, the advisory fees, listing on the stock exchange, the due diligence that is involved, it takes a lot of time. So typically, corporates would typically lean towards debt as a source, just to ensure that their weighted average cost of capital is lower, is as low as can be. So with this understanding, right, this is why you probably have to take out that misconception around debt as something to be avoided. As a startup, yes, you may be lean on ground, you may not have the cash flow, because when you don't have the cash flow, that's where it becomes a problem. So the moment you can scale, the moment you can take off the ground and cash flow starts to come in, you can actually leverage debt, but ensure that there's discipline around it. So I think that has to be dealt with. These are some of the other myths and misconceptions that bankruptcy erases all debts. People think that, oh, once I take a loan and maybe, for example, I'm a business and I can declare bankruptcy, the debt is gone. No, the laws allow that there's something called unveiling. They can go after the directors, they can go after proxies. So bankruptcy doesn't erase debts, as it were. One other thing is, and this is something we've also talked about, that people tend to, when I'm defaulting or I'm unable to pay, it is best for me to stay away from my creditors. Don't engage them, just go and bury my head in the whatever, don't pick their calls. There's nothing more damaging than getting to that situation where your creditor is calling you and you don't pick. In fact, most times, the fact that you were even reaching out and engaging and coming to see them, that alone sends a positive signal. I read a book, Donald Trump. This was what, when his business collapsed. The fact that he was engaging his creditors is what even gave him the leeway for them to say, okay, let's give you additional money, go and try again. So I think this is something that even if we don't take anything out of this class, I think this is of utmost importance. And this is even me being vulnerable, that is something that I also have to practice to ensure that, look, you stay afloat as an individual and as a business. Anyway, so we'll move ahead quickly, not to waste much of your time. So just want to, okay, let's really understand what debt is. For us, it's really, for me, debt is really just like more of pulling your future revenue today, right? To take advantage of what I'll call the time value of money. So you're pulling your future income or your future cash flow today into today, and then essentially using it to create a platform, create assets that generate cash flow that you can build on. If you look at debt in that perspective, then you'll see differently, rather than it's being just something that you take and then you have to pay back because there's an interest element. The idea around this is this: money that you hold today, time value of money that you hold today, in 2 weeks' time is not the same value. Next year is not the same value. And in Nigeria today, we're actually even seeing it realistically happen. So I have ₦1 million today. By next year, I'm not sure that ₦1 million can buy goods worth 400,000. So we are seeing that impact severely today. So the idea of debt is saying, look, let me go into my future person, my future business, pull cash that otherwise will come to me in the future, and let me have it in my hands now and use it rightly for what would create more cash flow. If you look at debt from that perspective, then your mindset begins to change. Because the truth is, money as it were, which is what you're actually buying when you take a debt, you're actually purchasing money. Money as it were has become a commodity today. The commodity because you either use it as a means of exchange, so you use it to pay for goods, you use it to pay for services, or you use it to store value. So when you invest in fixed deposits, treasury bills, you're actually storing value with money. And these are the two major reasons why people look for money: to exchange, so that if I have money today, I can exchange it for food. If I have money today, I can exchange it for clothing. If I have money today, I can exchange it for shelter. That is why there's always going to be a demand for money. And so debt essentially becomes the rent that you pay for having access to money to do either of these two things. So the idea around debt is, like I said, going into your future cash flows, pulling that future cash flow back into your present value and making the best use of it. So that at the time, so that you have the capacity, you build on capacity to sustain or maintain wealth. If we look at debt from that perspective, then I think it starts to change the color of how we perceive or we look at debt and see it as not something to be avoided, but something a tool that can actually be used to our advantage. And I liken it to fire. Fire is very dangerous. It's a naked fire. I put my hand, it's gonna burn me. But guess what? Every single thing that I've consumed today, yesterday, last week, probably passed through fire. It was prepared with fire. So debt in itself could be likened to that. But if we manage it properly, it can make our lives become the best. We can make the best use of what it is. Yeah. So basically, like I said, debt is just essentially pulling our future cash flow, and the interest, what we pay as interest or what you consider as interest, is simply the rental of that commodity money. That's what exactly interest is. And of course, it's going to be a function of various factors: how much more people are looking for money, what's the demand for money, what's the supply for money. Today in Nigeria, we are seeing a situation where the CBN is aggressively trying to control money supply. So what they are doing is they are making the cost of borrowing very high to dissuade, to control the demand. Because prior to now, part of what has spiked our inflation is the fact that there was so much naira, there was so much liquidity being pumped into the system, and it was chasing too little productivity. That is what also has led to the high level of inflation that we're seeing. And that's because maybe they believe that with all the interventions they were doing, all the single digit facilities they were granting to entities, there was so much of liquidity within the system. That excess liquidity was chasing too little productivity. And of course, besides all the other existential issues, security, low productivity, power issues, this also has now aggravated the situation in terms of inflation. So what are they trying to do? Control money supply, make it expensive so that price to rent money becomes prohibitive, right? So when you see it that way, you start to understand some of these economic principles and the way around whatever. Because the truth is that the modern economy is built on debt. The modern economy is built on debt. I don't want to take time to explain it, but that's a concept, and that's what even the savvy people who understand this leverage, the likes of the Dangote, the Boas of this world, they really understand this game properly. Okay, so we'll just move on. Basically, two types of debts. There are many more types, but just the broad types, just for high-level conversation: secured and unsecured. Secured, clearly, what it means is, of course, debt that has an asset backing it. Unsecured debt that is typically not having any assets backing it or collateralizing it. What you see is pricing or the rental on these two types vary depending on your credit worthiness, right? So typically today, I can tell you for free that a Dangote as he is, some of his debt stock is actually unsecured, and that's because he's built a very strong credit personality. We have also other people who have demonstrated that, and they can come to the market and say, you know what, my name is good enough for it. I'm an investment grade person. So if I take money from you and I'm paying the rent, I have the capacity to generate it. But if I even take it from you, you should be happy. And I think that's the goal that all of us need to aim for. And one way to do it is to ensure that we always repay. The question, so from a secured and unsecured debt perspective, those are really more of finance type terms. But I think what is most crucial for us here is as a more practical way of looking at debt is to look at two concepts, which I got from reading books. And this doesn't come from any business school or anything. That what is good debt, what is bad debt. Of course, the word good is some debt that has positive connotation around it. And having looked at it, I've come just realized that I think 3 or 4 things that connote good debt. Any monies that you can borrow and that can help you to improve your future cash flow is considered good debt. So without thinking about it, an investment in your education, an investment in your business, you are buying a new equipment, new machinery, you are essentially building your capacity to earn more. It will be considered good debt. You are buying, it helps you to earn more or save money. If it has to be either of those two things. So if you are buying a property, a house, you're investing in real estate, if it's going to save you money or earn you money, definitely it is good debt. And that is the preference for debt when debt should be considered. Debt becomes bad when we use it for consumption. And I think that's the major problem with Nigeria today. Debt becomes bad when we use it for consumption. We largely take debt to finance consumption. We are seeing a proliferation of all these loan apps, and most times, if you check, what are people using those things to do? They're using it to consume. They're consuming it. The moment money goes into consumption is something that it has no future benefit. You take it now, you use it, it's gone. You can't recreate it. Any monies that is raised for purpose of consumption, definitely, clearly, without thinking about it, will go into default. I've seen it as a banker. I've seen it one too many times. The moment a man has access to money, if you give 2 people money, even one with lesser capacity to pay at a point in time, the moment one with a more even powerful capacity at the time to pay. The moment he consumes it once, his ability to pay back becomes immediately impaired. Immediately, no matter how big the man is, no matter who he is, he becomes immediately impaired to pay. I've seen it one too many times. But you give a small man, even if a small man, a malam who goes to buy goats from wherever, comes to the city, cuts it up in the evening, he sells it. If you give him debt and he's able to use it and keep it within that business, definitely his ability to pay always remains or even gets stronger. But the moment there is 1 naira of diversion, one bit of consumption, the problem starts to occur. And that's when debt now starts to say, this is something to be avoided, right? So I think it's very important that we really be disciplined around how we apply debt to ensure that what we're using it for is something that either helps us to raise cash flow, improve our earnings, or save costs. Those are the things that are specifically allowable, and I will keep us from any sort of negative impact for whatever transactions we've got into. The problem I can categorically tell you, and I personally, I don't even think it's peculiar to Nigeria. Even in the American, the more developed economies, the credit cards that they have all have access to. It's all financing consumption, and that's why people just get into those holes and they're unable to come out. The moment you can ensure discipline. You can ensure discipline to separate that debt, use it for productive uses, then you're as good as fine. Most times, the chances that anything will go wrong, except for any act of God or any macro issues that may affect the business, you will most likely be fine. Most likely be fine. That's what I've seen as a person individually and as a banker. So basically, this is something I'm sure we all know, the different sources of debts. Of course, Madam mentioned family, friends, as one major source to raise debt. And of course, you then have all the other types of debt sources, the conventional ones, we know the banks, the microfinance banks, the discount houses and all those other agencies of the financial system that make available credit to businesses and individuals. But of course, we're also seeing emerging channels, the P2Ps, the peer-to-peer, that's what it means, the crowdfunding sources. We're also seeing these micro loans. Even though I think those micro loans are quite dangerous, because as easy as they are not just, most times when you take them easily, they are more of your data. And that's what they are really selling, not even more of the loans from what we see. It's your data that they are really mining and then selling off that data. And then when anything happens, they can come easily after you. So these are the sources of debt, basically, that But I think, like we have mentioned, and when looking at them, it is important that when looking at these sources of debt, one thing that is key is understanding the underlying contracts, the loan contracts. You must ensure that you understand in detail the terms, the conditions surrounding each of the contracts, the pricing, the interest rates, what's the price of this debt that I'm taking, what's the price of renting money. Most times you have to do some bit of detailed analysis as to check, okay, what's the inflation rate? If I take at this rate, how much better off am I? If I use this money, what's the future? What's the discount value going to be? If I take the money today, if I pull my future cash flow today, I use it, what would this money be like if I was going to take it maybe a year from now? There are many tools that you can use to do the analysis to say, okay, it's what's taking debt today. And that's why I said earlier, this is one of the reasons why the large corporates, they understand this, they understand and have these tools at their disposal. That is why most times you see them taking on significant debt. And you're wondering, how come, why? Why are they going when they have cash flow? Why are they taking debt? But because they understand this implication, they understand this concept that, for example, I can give you, for example, so just thinking about it, today we're in a very high inflation era in Nigeria. A man who took a loan of, let's say, 10 million 2 years ago and has put it in his business, in such a situation today, the man, and he invested it in his business, the man is currently, definitely, I can tell you for free, if he's running the business as hard as it is, he's making money. If you look at it in detail, if you look at it from the economic perspective and even from the accounting perspective, he will be making money. So long as he has cash flows coming in, even though he may say, hey, I'm not making as much profit now. But from a balancing perspective with what is happening in the economy, inflation, if you took money 2 years ago and you have it running your business, you are already winning. So if you have that sort of understanding and use of those tools, then you begin to understand why debt then becomes important. Of course, definitely there are things that we've talked about, and one of the most important thing here is when creditors look at how to make debt available to you as an individual and a business, what do they look at? These are the 5 items, the five that could have broadly called the 5 C's of credit. Some of you may know them. But I think the most instructive thing here, I think the first two things, the first 2 C's are for me, are very key. Your character and your cash flow. The other 3 elements are things that you can build and you can walk around. But you see, the first one, that is most important. And I think that is what is most key. Even when the situation is good, even when the situation is bad, this is how you build your credibility. So your character is very instructive. It's very important that you have a very good and positive and a strong character, never avoiding your creditors, even when situation is going against you, being able to sit on the table, renegotiate, engage, discuss, reaching out. It is very, very important. Even if when the business has to fail, the creditor is most likely going to consider giving you debt in a new venture because he has seen your manner of approach. I think I learned of a story of Femi Otedola when he started his oil business. Sorry, I don't know if you guys can still hear me. Sorry, I don't know if I'm speaking to myself. Sorry,
No,
just
sir, we
wanted
are,
to.
we are
Yes, we
with
can
you,
hear
sir.
you. We can
We are with,
Okay.
we are with
hear
you.
you. Follow you, sir.
So I was in a class where Femi Otedola, one of my early days in banking, while in Guarantee Trust Bank, he came and he gave us a talk, and he told us a story, and it was for me a very major learning point. So you see, when Femi Otedola today is buying majority shares in First Bank, he's become the largest shareholder today. I think he bought shares worth 18 billion this week, right? But it wasn't always like this for him. It wasn't always like this for him. So he said something that was very instructive. I think in the days when he started his oil business, I think when the days of Xenon Petroleum, I think that was one of the first companies that started the last mile delivery of diesel to corporates in Lagos, and then they started to spread out. I think something went wrong with the economy somehow, some way. He lost money, the business went down, and he was significantly leveraged, debt was high, cash flow was impaired. He said something that was very instructive, that he remembered a call from one of the bank CEOs. And I think the man was getting very frustrated and, Femi, why are you not paying this money? What's going on? Blah, blah, blah. My people are bringing your credit report to me. And he said, no problem, that can I call you back? He didn't call the man back. Then the first thing the next morning, he was at the CEO's office. That the man was shocked. Okay, you came to see me. And most people would run away. He said he sat down with the CEO and said, look, this is the problem. I'm here, but give me time. I'll sort it out. What can you do? Can you negotiate? They said, no, we can't negotiate. We can't do anything. You've been bad. This is blah, 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 blah. And immediately what he did was, luckily, of course, that's also the reason why you build assets, which is why I said, if you have the discipline to take debt and you can use it to go into productive things, real estate and all that. He then immediately quickly started to sell off some assets that he had. I think his mother had willed to him, so they had land and all that. He made sure he sold everything that he had, and he paid off. And that was for him. He said when he finished, he paid off the last money, right? It wasn't up to 2 weeks that the bank called him to say, okay, come, we've seen how, whatever. And I think that's how he got another one and he kickstarted. I think Donald Trump too has made a story around told the story around the same thing, how he had to renegotiate. In fact, he had almost declared bankruptcy. But the point that to the extent that he had assets that he could sell off, he didn't hold back. He didn't believe that, oh, what's my own? There's nothing I can do. Hold on to what you have and then let the bank be struggling and then I'll be managing them. If we are all able to fix this character issue, there's no limit to where we can go and leverage debt as an instrument or as a tool. If we are all able to fix this very major issue, and I think this is an issue that affects all of us, even me sometimes personally, when it's time to repay, oh God, man, this thing, I can actually have used this money to buy for, no, let me delay it a little bit. I think to the extent that we can fix this element, this part of our existence, there's no limit to how much we can leverage. And I think this is the secret for the likes of the Dangotes that we've mentioned. I told you, Dangote signs your offer letter for a loan today in the bank. You guys are almost more or less to a party. You can imagine. The bank wants to give you money. The man signs an offer letter. People are jumping in the office. They are buying pizza. That yes, Dangote signed the offer letter. And that's because they know that the man has it will be almost without thinking about it, he will pay no matter what goes wrong. Even when his refinery was struggling, it was teetering, there were startup issues with the refinery. Banks were engaging him. He kept giving them. He was bringing money from all the other businesses that were working and pouring it into that business. He was taking out everything that he had to ensure that the banks were happy, even if the payments were not up to what he expected. And that's because he understands the currency power of character. So I think it's something that we should, as people, as individuals, as business owners, ensure that we make a mantra where we go to take debt, no matter how, we ensure that we go out of our way to meet the due repayment on or before. If we can't, we reach out, we engage, we discuss, we negotiate. If we have to sell off things, if we have to, just ensure, because at the end of the day, you are building your credit, you are building a currency bank, and we will definitely draw on. I think that's, for me, the major point here. So I think in closing, so that we don't waste too much time, we've talked about some of the things you must look at. Thankfully, the first speaker mentioned, ensuring that you look through the terms and conditions, understanding what the tenors are, maybe the longer the better, what sort of penalties are embedded in the contracts. You must read those contracts clearly, understand it. If you don't understand it, get a financial advisor, which is part of what I do. I offer financial advisory. I could look at documents, I could help guide and say, okay, let's renegotiate for better pricing, let's engage. In fact, most times what people don't understand that when a creditor sees that you are negotiating, you're not just rushing to sign. In fact, for me, I'm more wary with a client who just quickly, I give him an offer letter and then he signs immediately. Most likely my chances, I start to raise my antenna with such a person. But I'm usually more confident when I start to see that the man is reading my documents, he's going through the terms and conditions, asking questions. Such people, most likely, I'm not saying there has been any sort of will I call it any sort of analysis or study, but most likely, out of my little experience, I've seen that such people tend to always repay. So it's also a very good thing for us to take time, go through these loan contracts. Yes, you may be under pressure, you need the money, but look at those things, ask questions, understand them, see if you could negotiate better pricing, always talk around better terms, and all that. Ensure that you go through. I think that's the major talking point here. So basically, of course, we've talked about what are the things that are happening within our space. We are seeing a whole lot of these loan apps. One has to be careful with them. Many of them have very prohibitive practices around them. I'm not going to recommend them. They're easier to get money from them, but the downsides with them are usually that you don't know where they are. They can start to do all sorts of unorthodox things. Recently, we've heard that the federal government has set up the Nigerian Consumer Credit Corporation, which will help people accelerate access to consumer credit. Now, I have a problem with this because this is the way the American system was designed and set up. This is where I have a problem. Even though I'm a banker, we make money from consumer credit. They're very quick. They're very whatever. But I will have to also say, with a high level of caution, this is not something you want to jump in. Like we have said, the preference is to take debt to fund production, to fund something that will either earn you more money or save you costs. The moment you start to take debt to finance consumption, even buying a car, if you're going to just buy the car and park it, then it becomes a problem. If it's not that you're buying the car to use it for an Uber business or a transport business, or the car is going to help you save cost in your business, maybe to help you reduce the fact that you have to hire vehicles to transport your goods to your customer. If that's not the case, then even me, this as good as this Nigerian Consumer Credit Corporation is, honestly, I would advise against making use of it, because it is just going to help you strengthen that negative cycle of use of consumption, and that is what puts us more into debt and makes our life even more miserable, right? We've talked about the fact that the credit reporting mechanism in Nigeria is getting stronger. The credit bureaus are becoming more efficient. So you are owing one entity today, then it's going to be a problem. In fact, I had a customer the other day. We didn't disburse his loan because Abuja Environmental, they had gone to the credit bureau. Those ones have now opened an account. So if you are owing your NEPA bill too now, they'll go and put it there. So it becomes a problem. So I think this is something that this is something that is being built ahead of putting in a proper credit scoring system, which the more advanced economies have, and you are seeing people doing everything to ensure that their credit score is not deteriorating, so that they can continue to have access to financing. What I think I'm also seeing that may happen is the Nigerian identification number. There are ongoing initiatives to link it to your credit system, so that with your NIN, everybody can just have an idea of what your borrowing capacity is, and come up with a credit scoring system. Those initiatives are currently ongoing and may be launched very soon. So we are seeing that Nigeria is also moving in that direction. But as the case may be, as these mechanisms happen, it means that people now have easier access to cash, because the banks are not going to be under pressure. As they raise all this capital now, they'll be under pressure to start to lend all this money, and a lot of all these schemes will be coming up. Easier access to money will be easier. But again, the point is, let's not get carried away. Let's ensure that whatever debt we take, it goes into productive uses, not consumer uses, because that's probably what we will see the banks do. They'll be throwing a whole lot of consumer products and all that at people, and people will just easily take them, go and buy cars, finance a holiday and all that. So we need to be very careful with that. Of course, we know what's happening now. Interest rates are on the rise, and that's simply because CBN, as an organ of government, is trying to catch inflation, keep it under control, limit people's access to cash. There's so much of cash chasing, no productivity, little or no productivity. So that's also a problem. And then, of course, it may not be the best time to take on debt because of the high rate. It may not be the best time. Alternative sources to raise funds may be considered. But of course, there's never a bad time to borrow, especially if you see an opportunity that you can leverage and you can turn around. So why not if not? But I think the idea is that the rates are significantly high. If you borrow today and you are paying 30, 34, 40%, there's except you're doing something unorthodox, maybe selling cocaine or whatever. I don't see what business margin gives you anything more than 40% that'll give you anything more than 40%. So except you just want to be working for your creditors or your financiers, these rates are prohibitive. I won't advise at this point. If you can find cheaper options, why not? If not, except you're going to go into short-term borrowings and exit quickly, just take the money, use it to bridge while you know that, okay, you will get cash from all other options to pay down. Why not? If not, just always look at money as a vehicle, as a commodity. It's not something that you should dwell there. So, but otherwise, any monies that you take that goes more than 1 year with this type of rates, not advisable, in my opinion. Okay, so I think just to summarize, it's clear that from what we said, debt is not a problem. So that myth or that misconception that is something that should be avoided is something I think we should play around with our minds. Let's have better understanding that it's not a problem in using debt. I think the problem is how we use it that gets people into trouble. And that was a statement made by Robert Kiyosaki. I'm sure we've probably all read his book Rich Dad Poor Dad, and it's a book is something that I also read and I have followed in my own personal life, as it were. So I think it's key that we don't look at debt as something to be avoided, but I think it is how we use it that becomes the problem. So how then do we use it? Like we've said, leverage debt strictly for investment purposes. Look at how the debt can be used for what can help grow your business, grow your. So if you invest in an education, you invest in a program or a course, of course, that's something that has no there isn't any cap on the returns on that. If you're investing in a machinery, in an equipment, even if it's a vehicle, so long as it's saving you cost, even if it's a mortgage, so long as you can do the numbers and you can see that, oh, it's saving me cost, why not? If not, if there's a way you can even buy the house and then maybe you fragment it and then you have a situation where you have other tenants and people are paying, why not? If not, leverage debt to do that, because how long do you want to how much salary, how quickly do you want to keep saving to pull resources together? So why don't you just go into your future cash flow, bring it today and invest in something that can expand your cash capacity? So I think that's one key way to look at how to use debt. Like we said, consider good debt only, avoid consumption related debt, ensure that we build a strong and positive credit history. So that speaks to ensuring that our character remains in place, making sure that we engage our creditors, we pay us at when due, even where there's a problem, you are quick to engage them, be the one to reach out, be the one to show that, look, you are concerned, this is what is happening. And that way your creditors are more at whatever. And I'm speaking from the perspective of a financier. If I have two customers, the customer that is always calling me to say, Oga, how do I pay this thing? I'm more likely to give that man money when he comes the next time, unlike one who I will call him, he won't pick. Or when I call him, oh, I'll call you back, he will not call back. Those are the things that because we are all emotional beings. And the truth is that the business of lending is an emotional business. It's nothing more than that. When people don't have this understanding, then they just start to box themselves into a corner. Like we said, prioritize repayment of your debts, because for each time you pay down your debt, you are investing in your future self. Because remember, you've gone into your future, you've collected the cash that will be available in your future. You've brought it in today. You are taking advantage of that future cash flow. So each time you pay your debt, just look at it that I'm just investing in my future. That's simply what you're doing. So if you look at it that way, then you will see that your debt, your ability to leverage debt becomes better. So in closing, just some of the things that we can do to ensure that we win with debt. Just make sure that, look, we're also very disciplined, borrow only what is needed. I think it's key that we maintain discipline. We've talked about that. We've talked about the importance of reading and understanding loan terms and conditions. People have signed contracts that have more or less sold their family out without them knowing, because they didn't read and understand. Ensure you take time. Never rush. Take time. Read it, even if it means a day or two. If you need to have a financial expert look at it, review for you, look at it, have a lawyer look at it for you, please. If not, please, if you can, ensure you do that. And always, as much as possible, try to see how you can always negotiate the lowest interest rates. Ensure that you try and negotiate where it's possible. Like we said, prioritize repayment of your debts, accelerate repayments, especially for the principal, as quickly as possible. I'm sure with all this, if we're able to deliberately do this, we will always win with debt. The next question becomes, oh, how then do I have access debt? I have issues with raising money, banks don't give, but those are other conversations. But I think the most important thing is to even have an understanding of what it is, so that by the time the funds come into your hands, we know what to do. So thank you very much. I don't know if there are any questions. I don't know if I've been able to do justice with the topic. I just want to also get questions or any other thing will be related to this or any other thing with respect to your business or what you are going through, anything. We'll just be happy to discuss it together. So thank you for listening. Thank you for your time. Thank you.
Thank you so much, Mr. Gbenga. That was a whole lot. Honestly, that was a lot on that. Do we have any questions, please? Any questions? Any questions? Mr. Akim, do you have a question?
Not at all, sir. I enjoyed the lecture very well.
Okay. Mr. Abdulaziz, any question?
Thank you very much. It was a lovable moment, and I think I'm okay for now. Thank you so much.
Okay. Mrs. Atim, any questions?
Thank you very much.
So I don't think we have any questions. Mr. Gbenga, thank you so much. This was
Thank you.
insightful
Thank you
and
very
a lot
much.
of information. Personally, I learned a lot. So thank you so much.
All right.
So guys, the material, the slides will be put in the group so that we can use it for further studies and research and reference too. Thank you so much. By next Saturday, we'll be having our usual discussion about the class, what we learned, and our different perspectives and takes on it. For today, thank you so much for joining. It's nice to see every one of you. Thank you to Mr. Gbenga.
Thank you very much.
Have a lovely day
Right, sir.
ahead.
Thank you.